Investment analysis evaluates how a real estate property performs economically over time. In earlier chapters, you explored the nature of investment, the risks and rewards tied to property ownership, and how taxation influences investor decisions. This section connects these ideas to one of the most common real estate assets, the primary residence. Although a residence is typically purchased for personal use rather than income generation, it still functions as an investment, capable of producing appreciation, leveraging opportunities, and tax benefits. A primary residence is considered a non-income property because it does not generate rental income, unless a portion of the home is used for business activities, such as a home office or a rental suite. Only the income-producing portion qualifies for depreciation or income-based deductions. The investment value of a residence comes from appreciation, tax advantages, leverage, and the financial stability provided by long-term home ownership. Understanding these components helps real estate professionals explain the financial implications of home ownership and guide clients in evaluating their long-term position. Appreciation. Appreciation is the increase in value of a property over time. This is the most common benefit for homeowners because even though the property does not generate income, it may appreciate significantly as market conditions change, neighborhoods improve, or demand rises. The simplest way to calculate total appreciation is to subtract the original purchase price from the property's current estimated market value. For example, if a buyer paid $125,000 for a home that is now worth $150,000, the total appreciation is $25,000. This gain reflects the overall increase in value before considering selling costs or taxes. Appreciation can also be expressed as a percentage. In this case, $25,000 divided by the original $125,000 equals 20% appreciation. To estimate annual appreciation, divide the total appreciation percentage by the number of years the home has been owned. If the home appreciated 20% over 4 years, the approximate annual appreciation rate is 5%. Understanding appreciation helps buyers and sellers evaluate long-term equity, timing of sales, and overall investment return. Deductibles. The most significant recurring tax benefit available to homeowners is the mortgage interest deduction. Homeowners may deduct the interest portion of their mortgage payments each year. Principal repayment, which reduces the borrower's loan balance, is not deductible. Depreciation does not apply to owner-occupied residences. Owners using part of their home as a rental unit or business office may deduct expenses related to that portion, but only that segment qualifies for tax benefits similar to income property. For most homeowners, mortgage interest remains the primary tax advantage. Tax liability. When a primary residence is sold, the seller may owe capital gains tax depending on the amount of gain realized and whether the homeowner qualifies for an exclusion. The calculation relies on two key components: amount realized and adjusted basis. The amount realized is the sale price minus the costs of sale. Sale price includes cash received, notes, assumptions of debt, or any form of consideration provided by the buyer. Costs of sale include commissions, legal fees, title charges, seller paid points, and certain advertising or marketing costs. These reduce the net proceeds. The adjusted basis reflects the total investment made into the property over the time it was owned. Beginning basis includes the original purchase price plus closing costs, such as title insurance, surveys, attorney fees, and transfer taxes. As the owner makes capital improvements, such as adding rooms, installing new systems, rebuilding structures, or upgrading major components, the basis increases accordingly. Any exclusions or credits the owner receives reduce the basis. Calculating adjusted basis allows the investor to determine taxable gain. Using the formulas discussed earlier, gain on sale is the amount realized minus the adjusted basis. If the property sells for more than the adjusted basis, the difference is the taxable gain, unless an exclusion applies. Gain on sale. To illustrate, Consider a home purchased for $100,000 with capital improvements totaling $5,000. The adjusted basis becomes $105,000. If the home sells for $175,000 and selling costs total $17,500, the amount realized is $157,500. Subtracting the adjusted basis from the amount realized results in a gain of $52,500. Unless the owners qualify for an exclusion, this gain will be taxable. Many homeowners are eligible for the gain exclusion, which shields significant portions of profit from taxation. Gains tax exclusion. Tax law provides substantial relief for homeowners by allowing exclusion of up to $250,000 of gain for single taxpayers and up to $500,000 for married couples filing jointly. This exclusion may be claimed every 2 years if specific conditions are met. The homeowner must have owned the property for at least 2 of the previous 5 years and must have used it as a principal residence for at least 2 of those 5 years. The exclusion cannot be used if the homeowner claimed it on another property within the previous 2 years. Losses on the sale of a personal residence are not deductible, and unused portions of the exclusion cannot be carried forward. Special rules apply when homeowners are forced to sell early due to job relocation, military deployment, or other qualifying circumstances. Understanding the exclusion helps sellers estimate their tax liability and determine the timing and financial impact of a sale. Review summary. Investment analysis of a residence focuses on appreciation, mortgage interest deductions, and potential capital gain at the time of sale. Unlike income property, a primary residence does not generate rents or allow depreciation. Its value lies in equity growth, tax benefits, and leverage. When the property is sold, determining amount realized, adjusted basis, and gain on sale helps the owner calculate tax liability. The gains exclusion provides valuable protection from capital gains taxes when ownership and use requirements are met. Together, these elements illustrate how personal residences can serve as powerful long-term investments. Discussion. Why is appreciation the primary source of investment return for a non-income producing residence? Answer. Because the property does not generate regular rental income or qualify for depreciation, its financial growth is derived mainly from increases in market value over time. How does the adjusted basis impact the calculation of gain on sale? Answer. The adjusted basis reflects how much the owner has invested into the property. Subtracting the adjusted basis from the amount realized determines the taxable gain. So a higher adjusted basis reduces the gain. Why are mortgage interest payments deductible while principal payments are not? Answer. Interest represents the cost of borrowing money and is treated as an expense. Principal repayment reduces loan balance and is not considered a deductible expense under tax law. Who qualifies for the capital gains exclusion on the sale of a residence? Answer. Homeowners who owned and occupied the property as their principal residence for at least 2 of the previous 5 years and have not used the exclusion during the past 2 years. Closing remarks. Although a primary residence is not a traditional investment property, it offers important financial benefits that shape long-term wealth. Appreciation, tax advantages, and leverage make home ownership one of the most stable and rewarding forms of investment for many Americans. Understanding how these elements work prepares real estate professionals to advise clients confidently, clarify the financial implications of selling or refinancing, and support homeowners in maximizing their long-term equity.